Dividends feel different, not exciting, not explosive, safe, predictable, reliable. While stock prices rise and fall unexpectedly, dividends arrive quietly, quarter after quarter. Cash appears in your account. No selling required, no timing decisions, just income. It feels like progress. It feels like stability. It feels like proof that your investment is working, and that feeling is powerful. Because uncertainty is uncomfortable, price movements are unpredictable. One day you're up, the next day you're down. But dividends don't behave that way. They follow a schedule: monthly, quarterly, annually, predictable payments, predictable income, predictable reassurance. And that reassurance creates trust. But to understand why dividends feel safe, you need to understand what they actually are. A dividend is a payment made by a company to its shareholders. It comes from profits. The company earns money, then distributes a portion of that money to investors. If you own shares, you receive your portion. It's your share of the profit. This decision isn't automatic. It's made deliberately. The company's board of directors decides whether to pay a dividend. They decide how much. They decide when. And once they start paying dividends, something important happens. Expectations form. Investors begin to rely on that income. They begin to assume it will continue. And companies understand this because dividends don't just distribute profit. They send a signal of stability, a signal of strength, a signal that the company has predictable cash flow, reliable income, consistent operations. This signal attracts a specific type of investor, not speculators, not short-term traders, long-term investors, income-focused investors, people who prioritize stability over rapid growth, because dividends transform stocks into income-producing assets. This is why many of the most established companies pay dividends. Banks, utility companies, oil companies, healthcare companies, large mature businesses that have already expanded, already dominated their markets, already reached scale. Because growth requires reinvestment, expansion requires capital, and companies focused on rapid growth usually keep their profits. They reinvest them. They build new products, expand operations, enter new markets. Dividends represents a different phase, not expansion, distribution, not future growth, present income. This is the first hidden truth. Dividends often signal maturity, not acceleration, stability, not expansion, and stability feels safe. But safety and growth are not the same thing. There's another reason dividends feel reassuring. They create consistency. Consistency builds psychological comfort. When investors receive regular payments, uncertainty feels reduced. Even if the stock price fluctuates, the dividend remains. The payment continues. This creates the illusion that something solid exists beneath the volatility, that the investment is anchored, protected, reliable. But this stability comes with a trade-off, because every dollar paid as a dividend is a dollar the company no longer has. It cannot reinvest that dollar, cannot use it to expand, cannot use it to grow. That money leaves the company and enters your account. Nothing new was created. Value was transferred, not generated, transferred. This is the second hidden truth. Dividends do not create wealth. They distribute existing wealth, and the market reflects this. When a dividend is paid, the company becomes slightly less valuable because it now holds less cash, and that reduction appears in the stock price. If a company worth $100 pays a $2 dividend, its value drops to $98. You receive $2, but your total value remains the same. You didn't gain anything new. You converted value from one form to another, stock value into cash. This feels like income, but economically, nothing changed. This doesn't make dividends useless. It makes them misunderstood. Dividends provide liquidity, convenience, psychological comfort, but not free money. Yet investors treat dividends differently. They trust them more because dividends feel intentional, and companies know this because once a company starts paying a dividend, stopping becomes dangerous. Dividend cuts create fear. Investors interpret reductions as signs of weakness, falling profits, financial stress, future uncertainty. Even if the company remains healthy, perception changes, trust breaks, confidence weakens, and stock prices often fall rapidly. This creates pressure. Companies become reluctant to reduce dividends, even when reducing them might be financially responsible, because maintaining dividends preserves investor confidence, protects perception, protects trust. But this protection has limits. Dividends depend on profit. Without profit, dividends cannot continue indefinitely. And when financial conditions change, dividends become vulnerable. Economic slowdowns reduce revenue. Reduced revenue reduces profit. Reduced profit reduces available cash. And when cash becomes constrained, difficult decisions emerge. Protect the business or protect the dividend. And sometimes, protecting the business requires sacrificing the dividend. This is when the illusion breaks, because dividends feel permanent, but they aren't. They are conditional, dependent on financial performance, dependent on economic stability, dependent on business survival. And when those conditions weaken, dividends disappear. Suddenly, unexpectedly, reliability vanishes, confidence collapses. Investors who relied on dividend income face uncertainty, not just from falling stock prices, but from disappearing income. This reveals the third hidden truth. Dividends are only as safe as the businesses behind them. Not safer, not guaranteed, just conditional. There's another deeper reality. Dividends don't protect against loss. If a stock falls 50%, dividends don't prevent that loss. They don't stabilize prices. They don't eliminate risk. They redistribute cash. But risk remains. Market risk, business risk, economic risk, all unchanged. Dividends reduce uncertainty psychologically, not structurally. The distinction is critical because safety is often emotional, not mathematical. Economists studied this decades ago. They reached a surprising conclusion. Dividends don't increase investment value. They don't change total wealth. Investors can create their own dividends by selling small portions of their shares. The result is the same. Cash received, investment value reduced proportionately. No wealth created, only redistributed. This challenges the core perception of dividends. They feel like income, but economically, they function like withdrawals. Structured withdrawals, scheduled withdrawals, convenient withdrawals, and convenience creates comfort. Comfort creates trust. Trust creates demand. But demand doesn't eliminate risk. Dividends feel safe because they are visible, tangible, predictable, but their safety depends entirely on the business, its profits, its stability, its survival. Strong companies can sustain dividends for decades. Weak companies cannot. Dividends don't create strength. Strength creates dividends. This distinction matters because investors often reverse the logic. They see dividends as proof of safety, when dividends are actually a result of safety, not the cause. Dividends don't protect companies. Companies protect dividends. And when companies weaken, dividends weaken with them. This is why dividends feel safe, but aren't always, because safety isn't defined by payments, it's defined by underlying strength. Dividends reflect strength. They don't create it. And when strength disappears, dividends follow. Not immediately, but eventually. Reliability fades, consistency breaks, and the illusion dissolves. Because dividends were never the foundation, they were the signal. And signals only last as long as the reality behind them remains intact.